Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Again, welcome to your daily Solo 401k webinar and Q&A session with My Solo 401k Financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic: keep more of what you earned, the $83,250 Schwab Solo 401k strategy. This is your chance to get answers. Please use the chat now to ask questions on today's topic or anything else. Again, please chat them over now so that we can be sure to get to them all. All right, let's get started. Let's start out with our discussion around eligibility. In order to be eligible to set up a solo 401k, you need to be self-employed with no non-owner, non-spouse, full-time W-2 employees. So think like an independent contractor, such as a realtor, a freelancer, an interior designer, someone who's self-employed. So the first element is you got to report earned self-employment income on your taxes. For example, on Schedule C, if your business is taxed as a sole proprietorship, or W-2 wages, if your business is taxed as an S Corp or a C Corp. Lastly, income reported on line 14 of a K-1 in the case of a business taxed as a partnership that files a Form 1065. Now, the other piece of the eligibility equation is that you cannot have any non-owner, non-spouse, full-time W-2 employees. So a full-time W-2 employee is someone that works 1,000 hours a year or more with a year of service, or 500 hours or year for 2 consecutive years. So you don't need to have a formal legal entity. We've got many individuals, for example, who operate as a sole proprietor. You do need to report earned self-employment income, again, with no non-owner, non-spouse, full-time W-2 employees. But there is no minimum amount of earned self-employment income that you need to report in order to be eligible. Your spouse or business partner can participate as long as your spouse or business partner are reporting their own earned self-employment income. You can have a solo 401k even if you have a W-2 day job, even if you participate in your W-2 employer-sponsored plan, as long as you've got that separate earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. So that is what allows you to set up a solo 401k. Now, the role of My Solo 401k Financial is we're a solo 401k plan provider. So a solo 401k plan is really a legal entity. It's a retirement trust. And like any legal entity, it's the documents that create it. But we are totally neutral as far as where the accounts are at. We don't hold or have access to your accounts. We don't force or encourage clients to go to any particular place. So our plan has the most advanced features, but it's totally portable. So you can have the account at the bank or brokerage of your choice. One of the top options where customers are opening up accounts for their solo 401k plan provided by My Solo 401k Financial is Schwab. So you can use Schwab for the assets, but you have the solo 401k plan for My Solo 401k Financial for the rules. So if you were to go to Schwab directly and open up a solo 401k with Schwab directly, it would be a very limited plan. It would be a vanilla plan. So it would lack the advanced features and support that's offered by My Solo 401k Financial. For example, Schwab's standard solo 401k plan does not support the ability to make mega backdoor Roth solo 401k contributions, doesn't support 401k participant loans, doesn't support the ability to invest in alternative investments. It doesn't allow the solopreneur to claim $1,500 in solo 401k tax credits like the plan that's offered by My Solo 401k Financial does. But you can have your cake and eat it too. You can have your accounts at Schwab, but also have the advanced features like the ones that I just mentioned by having the documents provided by my solo 401k financial. So the process is to obtain the documents from my solo 401k financial to unlock those advanced features, but still have your accounts at Schwab. And it's noteworthy that we are very hands-on in helping customers open up accounts at the bank or brokerage of choice. For example, for those customers or their advisors who want a custody at Schwab, we prepare the documents to open up free brokerage accounts at Schwab, whether it's at Schwab Institutional, if you're working with an advisor that custodies at Schwab, or whether you're just working without an advisor and you want a retail account for your solo 401k assets at Schwab. Now, to unlock the ability to make $83,250 in contributions to your solo 401k for 2026, you need to have a plan that allows for all the different contribution types. And you need to be of the age where you can make what's called a super catch-up contribution. So a solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals. And that's because you can make different types of contributions, provided that you have a plan like the one offered by my solo 401k financial that supports all the different contribution types. So for example, you're both the employee and the employer when you're self-employed. So you can make both types of contributions. For 2026, the standard employee contribution limit is $24,500. And then on top of that, if you're age 50 or older, you can make additional what they call catch-up contributions. The catch-up contribution limit, if you're age 50 plus, is $8,000. Or if you're age 60 to 63, instead of $8,000, it's $11,250. And all of those contributions, the regular employee catch-up, the regular employee contribution limit, plus the catch-up, those are all considered to be employee contributions. But you can make additional contributions with a solo 401k. You can also make what's called employer contributions. Now, the employer contribution limit is a percentage of your self-employment compensation. If you're talking about making employee contributions, you can make 100% of your earned self-employment compensation up to the applicable limit, $24,500, or additional contributions if you're age 50 plus. In terms of making employer contributions, though, your ability to contribute is a percentage of that self-employment compensation figure. And the percentage that applies depends on how your self-employed business is taxed. For example, if your business is taxed as a sole proprietorship, the percentage is 20% of your self-employment compensation, where self-employment compensation is equal to your net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. So you've got to run a pre-calculation to determine that self-employment compensation figure. And we have a calculator on our website that'll run that number. We also help run those numbers for clients every single day. But of that amount, you can contribute 20% as an employer contribution. Now, if your business is taxed as an S corporation, your ability to contribute is based off of the W-2 wages that you receive from the S corporation. In that case, the employer contribution limit is 25% of the W-2 wages, specifically box 1 of the W-2, plus any pre-tax elected deferrals not in box 1 and over in box 12. Keep in mind that you also have to consider the overall contribution limit, which for 2026 is $76,000, but goes up if you're age 50 or older. So that's how it's possible to go all the way up to $83,250. So if you have the self-employment compensation to justify it, you could contribute up to $83,250 to your solo 401k and make that as a tax either deferred, so pre-tax contribution, and or Roth or mega backdoor Roth contributions. Okay, great. So that's how you unlock the $83,250. Now, before we go through some more details on those contribution limits, let's field a question. I have a question regarding the 5500 EZ filing requirements. For cases where husband and wife have separate plans under their own name, social security number, do the combined balances need to be looked together? So that's a great question. So if the spouses really have separate solo 401k plans for their separate businesses, then each plan would consider their own balance to see if the $250,000 threshold has been met. Whereas if it's one plan, but both spouses are participating in that one plan, then you would aggregate all account balances, investments, etc., to determine whether the $250,000 threshold has been met. Okay, great. And by the way, if this information is helping you feel more secure about your retirement, please take 1 second to like this video. That'll help us to get the word out to other solopreneurs, other advisors like yourself, who might be trying to catch up on their retirement savings. We also invite you to subscribe. If you subscribe to our channels, whether you're on LinkedIn or YouTube, X, Instagram, that's going to guarantee that you get notifications of all of our crucial content that we deliver every day to help you secure your retirement. Okay, if there's more questions, please don't hesitate to chat that over so we can field those questions, whether on this topic or anything else. So now let's dig into those limits a little deeper to really understand how one could reach all the way up to $83,250 as a contribution for 2026. So remember, your ability to contribute is based off of different factors. One factor is how much income you make. You can't save more than you earn. Another factor is your age, right? As we learned on the previous slide, your ability to contribute goes up if you're age 50 or older. Another factor is the contribution type, because when you're self-employed, you're able to make both the employee and the employer contributions, because you're both the employee and the employer. Plus, if you've got a plan like the one offered by my Solo 401k Financial, you can even make a third type of contribution, which is referred to as a voluntary after-tax contribution, which is how one makes mega backdoor Roth contributions. Now, for 2026, the employee contribution limit is $24,500 or higher if you're age 50 plus. If you got a plan like the one offered by my Solo 401k Financial, you can diversify from a tax perspective. In other words, you can make some contributions as pre-tax, other contributions as Roth, or you could make all as pre-tax or all as Roth. You could alternate from one year to the next. Now, those $24,500 in contributions is going to count towards the $72,000 overall limit. In addition, another type of employee contribution is a catch-up contribution, but these don't count towards the $72,000 limit. So they actually increase it. That's how you can go all the way up to $83,250. So those catch-up contributions will come into play once the solopreneur is age 50 plus. So once they're age 50 plus, they can start to make catch-up contributions. The catch-up contribution limit for 2026 is $8,000. Or if you're age 60 to 63 during 2026, instead of $8,000, it's enhanced. There's a super catch-up contribution amount of $11,250. Now, these catch-up contributions may need to be made as Roth contributions per the Secure Act 2.0 rules. It depends. If your W-2 wages are over an applicable amount, $150,000 for 2026. So in that case, if you have W-2 wages that exceed the applicable amount, you have to make catch-up contributions as Roth contributions. But if you don't have W-2 wages, let's say your business is taxed as a sole proprietorship and you don't receive a W-2 from your self-employed business, even if you make a high amount of income, over $150,000, and you're in the age range where you have to make catch-up contributions, those Secure Act rules are not going to require you to make those catch-up contributions as Roth contributions. You could if you wanted to, but you wouldn't necessarily be required to. Now let's turn to the employer contribution limits. So that's another type of contribution that can be made to the solo 401k, because again, you're both the employee and the employer. Now, unlike the employee contribution limit, which is 100% of your self-employment compensation, dollar for dollar, up to the applicable employee limit, which can be contributed as a solo 401k contribution, the employer contribution limit is a percentage. And the percentage that applies depends on how your self-employed business is taxed. So for sole props, for LLCs, taxed as a sole prop. For partnerships, that percentage is 20% of your self-employment compensation. Now you've got to run a pre-calculation to determine your self-employment compensation. For a sole prop, for an LLC, taxed as a sole prop, that pre-calculation is line 31 of Schedule C. So in other words, your net self-employment income less 1/2 of the self-employment tax. If your business is taxed as a partnership, your pre-calculation is line 14 of the K1 that you receive from the partnership less 1/2 of the self-employment tax. Now, if your business is taxed as a C Corp or an S Corp, the employer contribution percentage that applies is 25%, specifically 25% of the W-2 wages. More specifically, 25% of box 1 of your W-2 plus any pre-tax elective deferrals not in box 1, but over in box 12. Now, those employer contributions can be contributed as pre-tax or even as Roth, thanks to the Secure Act. They can be made as Roth contributions. But in our experience with our solo 401k plan clients, most clients who are looking to maximize the dollars that end up in a Roth account would choose to simply skip making employer contributions as Roth contributions because they are discretionary. You could choose to simply not make employer contributions and instead use that self-employment income to make a voluntary after-tax contribution, because our solo 401k plan allows for those voluntary after-tax contributions, and then transfer those voluntary after-tax contributions over to a Roth. So a two-step process. First, make the after-tax contribution and then transfer to the Roth. That two-step process is referred to as a mega backdoor Roth solo 401k strategy. Now, these employer contributions, they do count towards the $72,000 overall limit for 2026. Now, lastly, let's touch on the voluntary after-tax contributions. Voluntary after-tax contributions is how one makes mega backdoor Roth contributions. So you have to have a plan that allows for both steps. You have to have a plan that allows you to make voluntary after-tax solo 401k contributions. So if you go and get a basic solo 401k from Schwab, their plan documents don't allow for voluntary after-tax contributions. They don't allow for mega backdoor Roth contributions, just like the other brokerages like Fidelity, etc. Then you also need a plan document that allows for that second step, the transfer from the after-tax solo 401k account to the Roth solo 401k. So you need to go through both steps. You make that first step, the after-tax contribution, so you can take advantage of the higher contribution limits. So for example, the voluntary after-tax solo 401k contribution limit is 100% of the self-employment compensation, dollar for dollar, up to the overall limit, assuming that you don't make any other employee or employer contributions to the solo 401k. So you could simply skip employee, skip employer, and just make 100% voluntary after-tax contributions. And if you've got the self-employment income to justify it, like the W-2 wages, for example, in the case of a business taxed as an S Corp, you can contribute 100% dollar for dollar up to $72,000 for 2026 as a voluntary after-tax contribution. So you first put that into a separate voluntary after-tax solo 401k account, and then you move it from the voluntary after-tax solo 401k account either to a Roth solo 401k as an in-plan transfer or to a Roth IRA. You want to move it from the after-tax account to the Roth account. So now it's going to act like any other money in a Roth account where it's got that potential for tax-free growth. So let's go through an example. Let's say someone is age 60 to 63 in 2026. Let's assume that they don't make any other contributions to another plan, like a day job plan, and they've got the self-employment income to justify the contribution. Let's assume, for example, that they've got at least $80,000 of self-employment compensation from their business taxed as a sole proprietorship, right? Where they run that pre-calculation, line 31 of Schedule C, less 1/2 of the self-employment tax. So they can contribute 100% dollar for dollar, or actually we're going to assume they have at least $83,250 because you can't save more than you earn. So they can contribute 100% dollar for dollar as an employee contribution up to $24,500 plus an additional $11,250 because they're age 60 to 63. Then on top of that, they can make an employer contribution of $20,000 because they can do, let's assume 20% of their self-employment compensation. Let's assume that they've got at least $100,000, right, of self-employment compensation. Sorry for changing the assumption. Let's go back to assume they got $100,000. So that's going to allow them to do 20% as an employer. They can do the 24.5 plus the additional 11,250 as an employee plus the super catch-up. And then they could do the difference up to that $83,250 as a voluntary after-tax. So they're able to put all these different funds to do these different accounts and get $183,250 into their solo 401k just based off of $100,000 of self-employment compensation. Now let's assume that the individual, instead of being age 60 to 63, let's assume they're 50 plus, but not quite 60 to 63. So they'd still be able to get all the way up to $80,000 for 2026 using those same figures into their solo 401k. The difference being that their catch up, instead of being $11,250, it's $8,000. So the key takeaway here is that the $72,000 limit applies to employee, employer, and voluntary after-tax solo 401k contributions. Those catch-up contributions are on top of the $72,000. Another big takeaway here is that if you want to make those mega backdoor Roth solo 401k contributions, you need to have the correct plan design, right? The plan documents, like the one offered by my solo 401k financial, that allows for those mega backdoor Roth contributions. But you can use those documents to open up the accounts at the bank or brokerage of choice. It's totally portable. So many customers, for example, are opening up accounts at Schwab or Fidelity, just to name a few. Okay, wonderful. So again, if this is helping you feel more confident about your future, please like this video to help us get the word out to other solopreneurs like yourself. Let's go back to the good question. So if the plans are different, we're back to the 5500 EZ question. But over time, the income may be split from the same business, split between spouses. Does the combined balance now important? So if those are really two businesses that are part of a controlled group or an affiliated service group, then you're going to want to use the combined balances to determine whether that 5500 EZ threshold has been met, even if you end up filing different 5500 EZs for each plan. Great questions. Thank you so much for the good questions. We want to invite you to our community. You can join quickly and easily at mysolo401k.net/my community. It's the largest community of solopreneurs, solo 401k advisors, just interested parties around these topics, which means we've got vibrant forums. We have a library of videos and webinars. So there's a ton of ways to learn, a ton of ways to share the knowledge. It's totally free to join. It's not just for customers. All are welcome. So please don't hesitate to join. You can join quickly and easily, again, at mysolo401k.net/my community. All right. Thank you for the great participation. We appreciate it. That's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this Solo 401k community. We'll be back here tomorrow with more crucial content to help you secure your retirement.